Hello and welcome to the first lesson of the Forex Inception course. As I hope you're aware, this course is intended to teach you about level 2 order flow analysis using various tools and indicators that are linked to institutional level data coming direct from the various exchanges around the world. We're going to kick off this lesson by taking a look at some of the basic fundamentals of the Forex market to really give you a solid education and set you up with the best chance of making profits consistently and reliably. I do genuinely believe that Forex represents the most lucrative wealth creation vehicle available anywhere on the planet, and anyone with the right knowledge and skills can use Forex to set themselves up for complete financial and lifestyle freedom. Successful trading can be learned, and it is completely replicable for anyone with average intelligence, but only if you're actually learning the right things in the first place, which is why the first lesson of the course is what it is. Forex is not like any other market in existence, and I don't just mean it's slightly different with its own idiosyncrasies and minor characteristics. It is polar opposite to anything else that's out there, and knowing those differences will make Forex the most profitable and easiest market you could ever trade in. But if you don't understand the differences, there's absolutely no point going any further. So today we're going to look at how the market is structured, who the biggest players are and how and why they trade, and how that affects how we should trade. And we'll look at some of the mechanics of how and when prices move and what that means for our profit making potential. Basically just getting an understanding of how the Forex market actually works so that you know what to look for and how to take advantage of this when you begin using the more advanced level 2 analysis tools. Later in the course, I'm going to teach you various different methods or strategies that exploit the advanced tools that we have available. But for any strategy or system to work, you need to know why it works and why the things you'll be looking at and the tools you'll be using are so important. So the first thing that I want to look at is what the Forex market actually is. Now, even if you've never traded before, you've probably got some familiarity with other markets like stocks, simply because they're talked about so frequently in the media. You know, even non-traders have at least some understanding of what the financial markets are. However, Forex is very different, and it really is the new kid on the block in terms of being open and available for people like you and I to be able to trade. And as far as financial markets go, this is probably the least understood of all of them. To start with, Forex is a utilitarian market. It exists purely to provide a service, and that service is to facilitate international cross-border commerce. If someone in Europe wants to buy something in Japan, they first of all have to change their euros for Japanese yen, and likewise if they were to sell something in Japan, they would have to change the yen that they received back into euros in order to spend them at home. That is the primary reason for the foreign exchange marketplace. International business dealings. It's a service rather than a means of investment. And up until the 1970s, it was only banks and central governments who had access to the marketplace and could actually hold large quantities of foreign currency. It's never been an investment opportunity outside of central governments. That by itself is very different to other markets. Everyone has been allowed to buy and hold shares in company stocks and commodities like gold for hundreds of years. Those kinds of markets have always been open to Joe Public, and as such, they have always been used for speculation and wealth accumulation. Foreign exchange, on the other hand, was closed to the public until the 1970s, and even then, for the next 20 years, it was restricted only to large institutions. It wasn't until the late 1990s, thanks to the internet, that Forex actually became accessible to the general public as an investment or a speculative opportunity. So this is a very new market, and it primarily exists for a very different reason to all the other markets. And understanding that is the first step in being able to trade it profitably. You cannot trade this in the same way you might trade stocks or commodities or equities. And the reason for that is because the prices move differently for different reasons than they do in other markets. And this is where it gets interesting and where most traders make their first mistake. We already covered a small part of this in the introduction webinar that you either attended live or you watched the recording of. So I'm not going to repeat too much of that, but I do want to expand on it a little bit more in depth before we move on, because it is so central and vital to successful currency trading. When most people look at a currency pair chart, they see a market. This chart of the Euro US dollar looks exactly the same as this chart of Google's shares. They're both displaying price bars with an open, a high, a low, and a close. And because they look the same, people assume that they are the same, and so they try to trade them with the same strategies, using things like support and resistance, and trend lines, and Elliott wave, and so on. But the truth is, any similarity is only superficial. It's an illusion. If you were a stock trader, you would look at the chart of the stock that you were trading, because that chart genuinely does contain all of the price information about that stock. A commodities trader would look at the chart of the commodity that we're trading and so on. These are complete markets, and you are seeing all of the price information for that single market. If you want to know the current market value of a stock or any other security, you only need to take a look at the price chart. That price is the whole price. It's the only price. It is the true market value. The information, in other words, on a stock chart is valuable. The information on a currency pair chart, however, is almost entirely worthless and useless if you're speculating for profit. Why? Because a pair chart tells you almost nothing about either of the individual currencies in that pair. The Euro US dollar chart on the screen tells us the exchange rate if you were to swap €1 for the equivalent number of dollars. It doesn't tell us the true market value of the euro as a currency, nor the true market value of the US dollar. Remember, the Forex market is a combination of multiple markets of individual currencies. They are all separate markets for independent, unrelated sovereign economies. They effectively represent the national economy of the country that they belong to. And just those 8 that represent the major reserve world currencies can be mixed and matched and combined to give us 28 separate pair combinations. So when you look at a single chart like the Euro US dollar, for example, you are only seeing a tiny fraction of the market, 1/28th or 3.5% of the market. The majority of the information that you need if you want to trade the euro or the US dollar is actually not on that Euro US dollar chart. It's out here in the wider market that the majority of people foolishly never bother to look at. Whenever you trade a pair chart, you are in fact trading 2 separate markets at the same time. If you want to think of it this way to try and bring the importance of the situation home, when you trade the Euro US dollar, you are effectively trading the European economy against the US economy. If you want to buy or sell one of those currencies in exchange for the other with the intention of making a profit from that exchange, first of all, you have to know what's happening with the euro as a market and then the US dollar as a different and completely separate market. As a currency trader, the clue is in our name, currency trader, not pair trader. George Soros is probably the most famous currency trader of all time. He made that $1 billion profit in one day in 1992, and he did that by selling the British pound. He saw weakness in the pound and he sold it across the board. He didn't identify weakness in the pound US dollar chart or the pound yen chart because of some arbitrary line that he'd drawn or an overbought or an oversold indicator or moving average. He saw weakness fundamentally in the British central bank policy and the pound as a single standalone currency. And he sold that currency in any and every pair that he could find it in. He wasn't trading a chart. He was trading a currency. He was effectively trading against the British economy and the Bank of England. Now think about what this means for your trading. When you look at the Euro US dollar chart and it's in a sideways choppy range like this, do you know why? It could be because the euro and the US dollar are both neutral. Each currency could effectively be flat, no activity or interest in either one, so the pair itself isn't really moving. But it could just as easily be because the euro and the US dollar are both strong or both weak. If both currencies are the same, both strong or both weak, there's no difference, there's no imbalance between them. So again, their pair chart, their direct exchange rate won't be changing because they're basically equal to each other. Now, just think about 2 cars racing side by side. They may both be travelling at 100 miles an hour. So to the outside world, they're speeding along. But compared next to each other, there's no difference. They're neck and neck. You could actually step across from one car to the next, as long as you didn't touch the floor, obviously, because relative to each other, it's the same as if they were stationary. There's no difference between their speeds, or in terms for currencies, there's no difference between their strength and weakness, no matter how fast or how strong or weak they are. So the pair chart is in a sideways range, or it's stationary. Now, what about a pair that is trending? If you look at the Euro US dollar chart and it is in an upward trend, do you know why? Well, it could be because the euro is strong and the US dollar is weak. It could be because the euro is strong, but the US dollar is neutral, or it could be because the euro is neutral and it's the US dollar that's very weak. A weak US dollar would drive the price of the euro US dollar chart upwards. Again, the analogy of two cars, you could have the first car stationary and the second car speeding away from it, or you could have the second car is stationary and the first car is speeding away from it, or both cars could be speeding away in opposite directions. All three situations would lead to a trend on a pair chart. But of course, you have no idea what is causing the trend or the sideways range on a chart if all you're looking at is that single chart, rather than the two separate markets that make up that chart. Charts don't analyze the individual currency markets. And by the way, of the three different situations there, which do you think would give you the strongest trend? It's the first one, isn't it? Having two currencies moving in opposite directions will give you a bigger move than if only one of the currencies is moving and the other one is flat. All three of these would give you a trend, but the first one is definitely better than the other two. Most failing amateurs will trade the euro-US dollar chart as though it were a market in its own right, just like gold or oil or a stock. And if they do that, they really have no idea why a trend or a range is happening, or even if a trend or a range is likely to happen. It's just blind luck if they get caught in a sideways range or happen to get lucky and hit a trend. They've got no way of knowing when either of those market conditions are likely to happen if all they're looking at is a single chart, because they're trading with incredibly restrictive and limited information. They're trying to trade whilst only looking at 1/28th or 3.5% of the market. They're not taking full advantage of all of the information that's available in the Forex market. Now, presumably, that was interesting enough for you when you first heard it to make you want to sign up to this course and find out more. And it's going to be the central topic for this course and everything that you do from now on as a currency trader. It's the most important principle that separates winners from losers in the Forex trading world. So that is point number one, and the most important principle that should be at the top of your list of things to remember. Individual currency analysis is the critical component that can never be ignored. Everything we do in Forex comes back to looking at the individual currencies. But that's really only the start. It gets much more interesting, and I didn't mention this next part in the webinar at all, so it's possible that this is the first time you've ever heard of it. What do you think causes the price to move on any market? When you look at a chart, whether that's currency, stocks, gold, oil, any security, what do you think is happening to make the price move? It's buying and selling, right? Buyers and sellers interacting. When there are more buyers, the price goes up. When there are more sellers, the price goes down. We talked about this a little bit in the webinar and explained about how it was supply versus demand between customers and market makers. Now that's true, and it's the only thing that can move the price in every other market, but not in Forex. In Forex, that's exactly what we want to look for. But the surprising thing is that in Forex, around 96% of all price movements happen without any buying or selling taking place whatsoever. Zero transactions, no buying or selling, no imbalances between supply and demand. So just think about that for a moment. An amateur trader is sat there looking at a chart and the price starts to go up. And this trader naturally and understandably thinks there is more buying pressure than selling pressure, and the price is rising because buyers are moving the market up. That is a perfectly reasonable assumption. Unfortunately, though, in Forex, the chances are the price move is moving without any buyers or sellers being anywhere near that market. And I know that sounds really odd, so let me explain. Let's take the pound US dollar, which is the chart that's on the screen right now. And we'll say that we are actually buying and selling that pair. We are genuinely exchanging British pounds for US dollars. So there is real buying and selling taking place there. There is an imbalance between supply and demand. But remember that a pair chart is not a market. A pair is two markets. In this case, it's the British pound market and the US dollar market. But don't forget that the British pound is not only compared against the US dollar. It's also compared against the euro and the Canadian dollar and the Japanese yen and so on. And that creates a very unusual and a very unique situation that you don't find in other markets. It's called triangular equilibrium. If we take three pairs, pound US dollar, the euro US dollar, and the euro pound, taking the price of two of them will give you the price of the third one. So if you multiply the euro pound by the pound US dollar, you get the price of the euro US dollar. Or if you divide the euro US dollar by the euro pound, you get the price of the pound US dollar. And finally, if you divide the euro US dollar by the pound US dollar, you get the price of the euro pound. Now, if you happen to have a calculator in front of you, pause the video and you can try that for yourself using either the example on the screen, or better yet, go over to your actual charts and look at those pairs. Maybe take a screenshot is probably best of all, so you've got 3 of them side by side static, so you can be accurate, and then do that calculation and you'll see that it works every single time. So what does that mean? Well, it means if the price on the pound US dollar changes because people have been buying and selling that pair, the other 2 pairs also have to change. That is a mathematical fact in the Forex market. All of the pairs have this kind of triangular relationship with 2 other pairs, and they always have to be in equilibrium. You may have heard of triangular arbitrage, and that's when if one of these prices didn't match the other 2 perfectly with this mathematical relationship, then high-frequency algorithmic traders could step in and exploit that inefficiency for a guaranteed profit. You can't lose in arbitrage situations. Now, that situation doesn't happen very often because it is very expensive to the market maker. They're basically being punished for mispricing their instruments, and that's the point. The prices of these pairs are not independent. They are mathematically correlated and determined by the price on the other pairs. When one changes, all of the others have to also. But it's actually far more complicated than that because the market is huge. In reality, the relationship is a bit more like this. Now, I've only put a few of them on here because you can imagine it gets far too complicated if we showed the entire market. But if you can imagine, this complex pattern extends out with hundreds of different triangles, all interconnected in a massive tangled web. So if we've got buying and selling taking place on the pound US dollar, so the price of that changes. But when it does, the price of the euro US dollar also changes because of that triangular equilibrium. And the euro US dollar is connected to 2 other triangles. So when that changes, these other pairs have to change as well. And of course, they're connected to other triangles. And before you know it, every pair in the market has just been adjusted to some degree or other, all because someone bought or sold the pound US dollar. And that is why around 96% of all price changes on Forex charts happen without any buying or selling. Now, that's bad news for amateur traders who don't know what they're doing. For want of a better phrase, most of the time they will be trading ghost moves or empty markets. It's not real price action, and it's not buying or selling that's driving the chart movement. Let's look at the example of the real orders happening on the pound US dollar pair. Someone is exchanging pounds for dollars, but imagine you happen to be trading the US dollar Canadian dollar pair chart. Well, here's the US dollar CAD. Whether there's real buying or selling on it or not, it is going to move. The price will change. The pound US dollar price has changed, and any pair in a direct triangle with the pound US dollar will also have to change. That is a mathematical certainty. And of course, those pairs are at the apex of their own separate triangles, which means lots of other pairs are also having to change. And somewhere down that line is the US dollar Canadian dollar pair. And actually, the US dollar CAD is also in a direct triangular relationship with the pound US dollar itself. As you can see here, the whole thing can get very incestuous and complicated because every pair is directly and indirectly related to every other pair. They're directly related in primary triangles like this and indirectly related via several degrees of separation like this. Now, don't worry if all of this sounds extremely complicated. Technically it is, but you don't have to worry about that. All you need to understand is all pairs are related like this, and when one moves, they all move. But the real transactions or the real orders may only be happening on one pair, and all of the others are moving simply because of this relationship. So what we're really interested in, if we want to exploit an edge in the market, is the real buying and selling. The example I'm using here is the real orders are concentrated on the pound US dollar. So there is real buying and selling. There's a flurry of activity, real people, real traders, and high volumes of currency being exchanged over here. This is where the buyers and sellers are interacting with each other. This is the crowded, busy marketplace that most of us are familiar with. This is the supply and demand imbalance. Over here, we've got our amateur trader looking at the US dollar CAD. All alone. Now, of course, he can see the price move, so he thinks he's in the right place and is probably drawing trend lines and support and resistance and all sorts of other stuff on his charts and making up lots of believable stories in his head about what's going on. but he's unwittingly trading an empty market. Smoke and mirrors, if you like. The price is moving on the US dollar Canadian dollar pair because it's basically being pushed around, but that's exactly it. The pound US dollar is moving under its own steam. It's moving because buyers and sellers are buying and selling, and there is a supply and demand imbalance. It's a real move. The US dollar Canadian dollar is moving because it's being elbowed and shoved and bounced around like a pinball. There's no actual order activity or order flow. If the buyers and sellers are over here on the pound US dollar, you're much more likely to see a nice, smooth, steady and gradual trend like this. The US dollar CAD chart is more likely to look like this. Yes, there's movement. Yes, there is an overall trend. But which of these markets is going to be easier to trade and easier to make a profit from? If you had the choice of opting for one or the other, which of these would you choose? Now, there's two important differences between these two situations. The first is quite obvious. The chart with the real order activity has the bigger trend, so there's more profit to be made on that chart. You could still make money on the US dollar Canadian dollar because there is a trend. It's just a smaller one, and therefore the profits would be smaller. But the more important difference is the reliability of that trend. On the pound US dollar, with the real buying and selling and real supply and demand imbalances, that's a reliable trend. There's a huge amount of money going into that, so there's a real force behind it. And it's likely to continue. It's likely to be quite smooth, and it's unlikely to experience any volatile changes in directions or whipsaws. The US dollar CAD is far less reliable, because without the real buying and selling, it's just being pushed around. But not only by the pound US dollar. Another pair somewhere else in the market could push it in the opposite direction, and then another direction can come in again, even if it's only temporarily. Remember, this is basically an empty market that's at the mercy of what's happening elsewhere that it's connected to. It's got no ability to resist being pushed around. So the trend on the US dollar Canadian dollar pair is far less likely to continue. It's more likely to be quite choppy, and it's more likely to experience volatile changes in direction. In essence, of those two charts on the screen, one of them is a high probability trade, the other is a low probability trade. So that is point number 2 to put on your list of important things to remember. You don't have to remember any of the mathematics or formulas. You just need to remember that most prices move without any real buying or selling transactions taking place on them. They're just being pushed around by real moves that are happening somewhere else in the wider market. All the more reason not to rely on charts when you're trading Forex, because you can't see from a chart if the move is real or not. Now, the question, of course, is how do you tell the difference? Well, to do that, you've got to understand who the market participants are and how they trade. In very simple terms, there are two main groups: bank dealing desks and market makers. It's obviously more complicated than that, but for the purposes of being able to make money, these are the two important groups that we need to know about. Banks account for nearly 2/3 of all the volume in Forex, 64%. They are by far the biggest participants. You can see that hedge funds are only 8% of the market, and the retail sector, which are people like you and I, make up only 4%. The big players are the banks. They're the ones who move the market on a day-to-day basis, and I'll come back to them in just a moment. The other group are the market makers. Market makers do what the name suggests. They make a market, very much like a regular shop on your high street. They're effectively a service provider who make it possible for buyers and sellers to buy and sell. They are the middleman. So let's say we have a buyer and a seller, and they both have an account with the same broker. They're both looking at the same exchange rate pair. They both want to trade the same amount, and they both hit their order buttons at exactly the same time. It would be easy to think that they get matched with each other, but they don't. Buyers and sellers on the customer side like this never interact with each other. They never come into contact or have any relationship whatsoever. Buyers always deal with the market maker who sells to them, and sellers always deal with the market maker who buys from them. As I said, the market maker is the middleman. A currency trade is a straight swap of one currency for another. And you've done this yourself if you've ever gone on a foreign holiday. You go into your bank or the money desk and you hand over your local currency, and they give you the equivalent amount of the foreign currency. And when you come back from your holiday, you hand over the foreign currency and they give you back the equivalent amount of your local currency. That's exactly what a market maker does within the interbank Forex market. They sell currencies to people who want to buy it, and they buy currencies from people who want to sell it. And you'll have noticed when you do change your holiday money, the price you buy at is very different to the price you sell at. And it's exactly the same in the Forex market, only on a smaller scale. Market makers will buy from you at a low price and they will sell to you at a slightly higher price. And the difference between those two prices, known as the spread, is how market makers make their profit. That's the fee they charge for providing you that service of allowing you to change your money. The most important thing to know about market makers is that they are on the other side of almost every transaction. It is their job to take the other side of a trade. When someone wants to buy, market makers are the ones who sell to them. And when someone wants to sell, market makers buy from them. So as you can imagine, they are the most active participants in the market. It doesn't matter if the price is going up or down, or if buyers outnumber sellers or sellers outnumber buyers. Market makers are on the other side of those transactions. They are the liquidity providers. They make trading possible, and the market wouldn't exist without them. They make the market, hence the name. Now, let me quickly come back to the banks, and bear with me if this is all starting to sound a bit complicated. It's all going to be very simple in just a moment. I said a moment ago that the banks are the biggest players who move the market, and there is a very clear difference and distinction between banks and market makers. Banks are effectively customers, either trading on behalf of themselves or more often trading on behalf of their own customers or clients. They are the traders who put the real orders into the market. And remember, it's the real orders that we want to look for. So as an example, let me use my own company, Complete Currency Trader. We do all of our online sales in US dollars, as you've experienced, but we're based in the UK. So we need to exchange the US dollars we get from the website sales into British pounds. And let's say that 1 month I ask my bank to convert $100,000 into pounds. Well, what the bank actually does is exchange that in the interbank forex market on my behalf. As far as I'm concerned, my bank has changed my money for me, but what really happens behind the scenes is they exchanged it in the market. Now, obviously, this is all happening very quickly electronically on computers, and this is what it looks like. This is the interbank forex market. It's basically what we look at as well on our chart, and it's made up of market makers quoting how much they're willing to buy and sell and at what prices. Then the banks are the customers, and they have big trades to make either for themselves or for their clients, as the example I just gave you, and they trade with the market makers. You see something very similar in your trading platform when you look at a chart. You see two prices, a bid and an offer. Those are the quotes from the market makers. When you want to trade, you hit your buy or sell button and you trade with the market maker who's made that quote. Your trading platform is basically a slimmed down miniature version of what the main interbank market actually looks like. Now, obviously, it is far more complex than the simple illustration I'm showing you here, but when all is said and done, it's these two groups that matter most and who you need to be aware of in order to make profits. Banks and market makers are the big players who trade with big money and leave big footprints for us to follow. If I can see where these two groups are most active, then I can identify the real moves and avoid the fake moves. In other words, we can find and follow the moves that are being driven by real transactions and avoid the 96% of ghost moves that are being pushed around because of that mathematical triangular equilibrium that we talked about. Now, I don't want you to worry or be too concerned that all of this suddenly looks far too complicated or difficult, because it isn't. In fact, the point of this course is to demonstrate to you just how simple trading Forex can be. And I'm going to go out of my way to keep it as simple as possible. In the next lesson, I'm going to show you how to find where the banks are trading. And then in lesson 3, I'm going to show you how to see where the market makers are active. And both things can easily be done by looking at simple patterns on the analysis dashboard and in the core volumes and the bid and ask indicators. When you put it all together, you can very quickly identify the highest probability conditions on every single currency. Reading the real market is not that difficult at all, partly because there is so much information available to us. Now, at first, it may seem like information overload and too complicated. So many different currencies, so many different pairs, so many different correlations and so on. But that's what makes Forex so profitable. There is so much more information compared to other markets that you can much more easily pick out the high value elements and select where the high probability conditions are and avoid the uncertainty that most traders have. You're not relying on a single chart. You've got way more information to help you. Now, the things to remember from this lesson are, first and foremost, the Forex market consists of individual currencies, and the main principle behind successful trading is to match strength against weakness. Find the strongest currency and trade it against the weakest currency. That will make you more money than any other principle in trading. Secondly, The majority of prices on charts move without any real buying or selling transactions taking place. For want of a better phrase, they are ghost moves. Your job, if you want to be profitable, is to trade where the real orders are. And you do that by following the two biggest market participants, the banks, who are the biggest customers, and the market makers. They leave telltale patterns that show us where they are, and we can follow them. We can ride along and we can profit from the trends that they cause. That's what I'm going to be showing you in the next two lessons. This first lesson has really been just about laying the foundations. Trading is simple as long as you do it properly. And doing it properly, first of all, requires a basic understanding of facts and reality. And that's what I'm trying to give you here. Hopefully this has been quite insightful and it's opened up your eyes to things that you've never seen before. You don't see what we've just covered being discussed widely among Forex traders. If you take a look around the various sites and forums, you're going to see that everyone's doing the same thing, using the same strategies and the same theories that are just dragged across from other markets. The majority of people are trying to trade Forex the same way they trade stocks, and the majority are getting abysmal results. Successful traders are in a minority. So if you want to be successful, you have to avoid whatever the crowd is doing. The crowd is always wrong. They're wrong about everything, especially when it comes to money and how to make it. If you want to be in the top 1%, you have to do what only 1% of people do. Avoid copying the crowd at all costs. In trading, that means avoiding the popular strategies that everyone else is following. And I hope that I've shown you enough so far in this lesson to convince you that individual currency analysis is the more effective way to earn money from Forex trading. If you're not convinced yet, I'm sure you will be by the end of the course. Please take the time to re-watch this lesson more than once. It's very important that the information sinks in and you fully understand it. I'm sure you've got questions, but they are going to be answered in the following lessons as we build on this piece by piece. By watching a video just once, that's never enough to properly absorb the information. So please make the effort to watch this a couple of times more. That's it for today though. I hope you've enjoyed it and please look out for lesson 2 in your inbox tomorrow. Thank you.